Let's be real, tax season is a pressure cooker. It feels like one tiny mistake could spell disaster. But what if I told you a last-minute error could actually become a strategic move? Today, we are cracking open one of the savviest tools for protecting your assets, the superseding return. So picture this. You've hit submit on your tax return. You breathe that huge sigh of relief. But then it hits you. That sinking feeling. You missed a huge deduction, or maybe you forgot to report some income. The deadline is breathing down your neck. What do? Because believe me, your next move is absolutely critical.
And you're not alone. This happens all the time. That pit in your stomach when you realize you've made a mistake after you filed, but before the cutoff. It could be anything, a 1099 that came late, a business expense you miscalculated, or a massive deduction you just left sitting on the table.
So what's your first instinct? You go back into your tax software and you look for that big friendly button that says Amend Return, right? I mean, it seems like the most obvious thing to do. But hang on. That simple click could be setting a trap, one that basically puts a giant target on your back for the IRS.
Okay, this is where we need to get strategic. Using that amend function, especially before the deadline, creates a risk you just don't need to take. Filing an amended return, which is usually done on Form 1040X, is like sending up a smoke signal to the IRS that screams, hey, over here, I messed up on my first try. Maybe you should take a closer look at everything. So let's break this down. It really comes down to two different paths. On one side, you have the amended return. This signals a correction to the IRS, which, yeah, can definitely increase the odds of an audit. But on the other side, you have the superseding return. This is treated by the IRS as the one and only original return. It literally overwrites the first one, making your mistake vanish without ever raising that same red flag. Now, here's the wild part. Your own tools can work against you. Most of the big-name tax software programs, well, they just aren't built for this kind of advanced strategy. They funnel everyone toward that amend button. This can accidentally send an amended return signal to the IRS even when you file on time. And even worse, sometimes the old incorrect data can linger in the system, creating confusion and triggering those dreaded discrepancy notices later on. And this quote from our source material really just nails the problem. The tax system operates under a split reality, where stated rules diverge from operational reality. What does that mean? It means there's a huge gap between the official rulebook and how the IRS's computers actually process your information. Their systems have limitations, and a simple fix can get gummed up in what the report calls statutory friction. Knowing this gap exists is the key to protecting yourself.
So how do we play this game and when? We use the superseding return. You should really think of it as your own personal audit shield. It's the savvy, expert-level move that fixes your mistake while keeping you under the radar.
Let's get really clear on what this is. A superseding return is just a corrected second return that you file before the tax deadline. That's the key. The IRS's own internal procedures say this new version completely replaces the first one. It's not an amendment, it's a total replacement. It becomes the official return for that year, period.
And you might be thinking, this sounds complicated, but qualifying is incredibly simple. It's just 3 steps. 1, you have to have filed an original return already. 2, you find the error. And 3, this is the most important part, you file the corrected return before that final deadline. It's all about timing. If you get the timing right, you win.
To really see the difference this makes, let's check out a tale of 2 filers. We'll call them John, who falls right into the common trap, and Jane, who acts like a true architect of her financial defense. They both run into the same exact problem, but the choices they make lead to wildly different places.
So here's our setup. We've got John, a consultant, and Jane, a real estate developer. Both are on top of things and file their taxes early. But then John realizes he overlooked $50,000 in income, while Jane's accountant finds she completely missed $40,000 in depreciation. For both of them, the clock is ticking.
Okay, now look at what happens next. On April 13th, just 2 days before the deadline, John panics. He logs into his software and smashes that amend button. But Jane, on April 10th, she has her accountant calmly prepare a new paper return, and they write superseding return in clear letters right across the top. 2 people, 2 very different strategies. And here's the aftermath. John's amendment immediately triggers an audit flag. He gets hit with an extra $13,000 in taxes, not to mention potential penalties. Jane, on the other hand, she completely avoids the audit flag, actually reduces her tax bill, and gets a refund. The difference in outcome here is just staggering. Let's just put a number on it.
By being a financial architect and using the superseding return, Jane didn't just dodge a massive headache. She pocketed over $14,000 in tax savings. That is the power of strategy over reaction. So you see how powerful this is? The next logical question is, okay, how do I do this perfectly? Well, it takes precision. So let's run through the Asset Defender checklist. This is the exact protocol you need to follow to file a superseding return and protect your money.
All right, this is your playbook. First, because of the software trap, you'll probably need to file this on paper. You have to clearly write Superseding Return right at the top of the new Form 1040. Second, attach a brief, simple statement explaining why you're making the correction. Third, and you cannot skip this, file it using certified mail with a return receipt. That receipt is your golden ticket, your proof that you filed on time. Fourth, keep copies of everything. The original return, the new one, the mailing receipt. Put it all in what the pros call a legacy vault. And finally, be ready for that statutory friction we talked about. If the IRS system messes up and misclassifies your return, you'll need that proof to call them and get it fixed.
So there you have it. You now have a powerful piece of insider knowledge that most taxpayers completely miss. The superseding return isn't just a way to fix a typo, it's a way to control the story you tell the IRS and actively defend your assets. So the only real question left is, how are you going to use this to your advantage?